Welcome to the Mind of a Millionaire podcast, where we discuss the habits, routines, and choices that lead to financial independence. Today on the podcast, we're starting over.
No, I'm leaving that in.
Welcome to the Mind of a Millionaire podcast, where we discuss the habits, routines, and choices that lead to financial independence. Today on the podcast, our December portfolio review meeting. So today on the podcast, we're talking about our portfolio review meeting, which we held December 7th. And it's interesting when we talk about these, by the time you listen to this podcast, it's probably going to be late December, early January. And, in our December podcast, we're talking about things that are happening in November. And by the time it actually gets to you guys, it's, almost 2 months later. So in some ways, the information we're talking about could have changed dramatically since we had the meeting, but I still try and keep the conversation as close to the meeting as possible because I actually like having a record of what we were thinking at a given point in time. So, Austyn, hi.
Hey, Zach. How are you?
I'm good.
Good. You have any? It's December 23rd. You have any big Christmas plans? Any big Christmas traditions that you and your family celebrate?
We got a pretty good list of Christmas traditions. We have historically, we've done New Year's Eve Mass, followed by Chinese restaurant. Since COVID, last 2 years, we've done Chinese restaurant at home with friends. Tons of board games, man, Monopoly, Settlers, Catan, Hearts, Poker. Farkle is probably the family favorite now. I don't know if you're familiar with Farkle. It's a dice game.
I think so. I've heard of it. Probably from you.
Farkle's magical. And then we do, we got like 3 days of traditions.
That's sweet. I love hearing people's traditions, but they're always kind of the same. And it's great. It's family. It's low key. It's food. It's games. It's movies, music.
What do y'all do?
Magical.
What do you guys do? The Garcias.
Yeah, all of the above. We previously did Christmas Eve hibachi, so similar to yours. I think that's Japanese. Sorry if it's not, but we do hibachi on Christmas Eve. Play some games. We'll have some family come in town. Christmas Day, we'll do like a holiday brunch with a different set of in-laws and family, and then spend the day drinking wine, eating appetizers and finger food. That's about it. I mean, not much for New Year's Eve. But
and New Year's Eve for us has always been like we make nachos and just drink apple cider and champagne and play board games. I mean, that's what we do. We play board games.
I love board games. Me and my buddies. So I and this is going off on a tangent, but I love talking about it. When I was in Fort Collins at college, I worked at a liquor store. When you work at a liquor store, you don't have very favorable hours. So you have to work weekends. Generally, you have to work most holidays. You can say, I want Thanksgiving off, or I want Christmas off, or I want New Year's Eve off, but never all the above. But one year I was working on New Year's Eve. And so my friends came up on December 28th to celebrate a pre-New Year's Eve, but we did it with all the frills. We got all the decorations. We got all gussied up. We went out to dinner. We did the countdown at midnight on December 28th. And it was the best holiday, best way to celebrate that holiday. And I mean, you go out, Ubers are cheap, dinner is not
the
packed,
3 day
easy
early
to make a reservation. Yeah. It was the best. And since then, we've actually carried that tradition forward and do our New Year's Eve on December 28th. So
that's fascinating. My wife and I, we're going to talk investments in like 30 seconds. Hang on. We started doing Valentine's Day on February 13th for that reason, because when we were broke college kids, all the menus were like the pre-fee menus where it was $100 a person and we didn't have the money. So we just started going out the day before Valentine's Day, and we still do that. And it actually is pretty awesome.
Oh, so much fun. I hadn't thought of Valentine's Day. That's a good way to do it. But all right, yes, we can get into investments. One thing you touched on though, Zach, that I don't want to breeze over is you did mention that once this podcast hits your feed, our listeners' feeds, it won't be December anymore. And the same is true with November. We just released our November portfolio review meeting. And I want to talk about some of those things and just see if your thoughts are still consistent. So we talked about corporate taxes. Not much has changed there. We talked a little bit about inflation. The Fed came out last week, and Fed Chairman Jerome Powell talked about that a little bit. So things might be changing, rates might be going up a little bit sooner than anticipated. But I also want to touch on small caps. That was a big one that we talked about at the end. Do you still have that same bullish outlook on small caps over the next 6 months to a year?
Yeah, I'll talk about small caps. Then we better talk Build Back Better plan. Yeah, small caps, they are very sensitive. If you missed the November portfolio review meeting, small caps are getting crushed this year. And true to form, when we recorded that podcast, like the first week in November, small caps were just down a little bit. Or I think actually I listened to that podcast the other day. When we did that podcast, small caps were up 7% for the year. As of December 7th, small caps were down like 10% on the year. So November turned out to be a horrible month for small cap companies. I think we have gotten to the point where there is definitely like there's ridiculously inexpensive prices for rapidly growing companies. Now, I never would predict anything in 6 months. I think it was Warren Buffett who said, if you give a number, don't give a time frame. If you give a time frame, don't give a number. So I would never say small caps will give a certain percent in 6 months. That's there's another great quote that the market can stay irrational longer than you can stay solvent, meaning you'll run out of money if you keep betting in a single direction. That being said, if you can put it on your, we talk about this a lot. If you're an equity investor, give yourself 5 years. If you can put on your 5-year hat, which is what I would encourage you to do. I don't really care too much about 6 months. If you can put on your 5-year hat, the value in small cap companies is completely outrageous. They are fast growing. They're inexpensive. They're, by all metrics, they're places we want to be invested. So if you put on your 5-year hat, I love small caps right now. I think it's a wonderful place to invest. And they have gotten more wonderful in the last month because they've dropped about 10% since the November portfolio meeting.
On sale. Sweet.
On sale. The other big thing that's happened since the portfolio meeting is the Democrats have failed to pass their mega legislation. All the press and stories have been about how Joe Manchin, the senator from West Virginia, has single-handedly defeated Joe Biden, the Democrats, and prevented them from passing Build Back Better. I put this on Twitter. No one thought it was as clever as I did. But it wasn't just Joe Manchin that stopped the legislation. It was Joe Manchin and 50 Republican senators. So it wasn't one rogue guy from West Virginia who didn't like it. It was 51% of the U.S. Senate didn't like it. But that being said, that is quite a blow, and it has some major effects on your investment portfolio. One is that program was incredibly inflationary. So as bad as inflation has been this year, over 6%, not passing that bill actually reduces the prospect of future inflation. And that's one of the reasons you've seen, now it is December 23rd. You've seen the stock market run up quite a bit in the last week or so. One of the reasons is if that bill doesn't pass, inflation is more reasonable, because that was depending on who you ask, a $2 to $5 trillion spending bill. So that's been a very big development since even the December portfolio meeting. Anything else on catching up?
No. What about covers it?
Okay. Well, what we talked about in our December portfolio meeting is how do we make money in 2022? And we've basically developed 4 themes that we think are going to, I just said, hey, we're not gambling on the next 6 months or even the next year. We really put on that 5-year hat, but we are not oblivious to the fact that what's happening in the next year is really going to affect investments and markets. So our 4 themes for 2022 was the main topic of our portfolio meeting. And the first theme is that big tech keeps getting bigger. And I kind of, in my mind, I like to think about it like, if you think about infrastructure, like what's infrastructure when people refer to that? Bridges,
Roads.
Highways.
I said roads.
Roads, yes. Offices, water treatment plants. The things that make our old-fashioned economy go round. Well, there's a new type of infrastructure. And the infrastructure are the companies that have basically been completely rebuilding our economy over the last 21 years. And they are, I think I can say these because I'm not talking about investing in them. I'm just talking about them conceptually. Amazon, Google, Facebook, Apple,
Microsoft.
what I missed, Microsoft. These companies, I call them infrastructure companies. And they're infrastructure companies because the rest of the internet is built upon them. So if you're into cryptocurrencies, you're probably familiar with Ethereum, which is kind of like the number 2 cryptocurrency behind Bitcoin. Amazon Web Services processes, I think it's 58% of all Ethereum transactions. So even if you want to build a revolutionary world-changing technology, you do it on one of these platforms. In fact, if you look at the cloud market, so cloud infrastructure service providers, Amazon is 32%, Microsoft's Azure is 20%, and Google is 9%. So that gets you over 60% of the cloud, which everyone uses the cloud for everything now. The cloud is over 60% of the internet is controlled by those 3 companies. And you've probably all heard of the network effect. The network effect is basically that as people become, or as companies have more users, the value of that service starts to increase. So like if you think about Facebook, if there was 10 different iterations of Facebook, like there's MySpace, there's Facebook, there's Garcia Bouck, there's Austyn Bouck, there's 50. You like that?
Yeah, no, I love, that's my favorite platform.
The Garcia Bouck?
Mm-hmm.
If there's 10 different social media companies out there, it's not as valuable as having every single person on one social media company. And that's basically what the network effect is. Value is created in tech companies as they get more and more users. So you're seeing that not only in the cloud space, but also in the advertising space. So Google and Facebook in 2007 controlled 4% of global advertising. In 2019, they control 37%. Same thing, the network effect is happening where these companies control more of the internet and their advertising becomes more effective. And when it's more effective, it's more expensive. But if it works, more people are paying for it. And then, and the last thing I'll mention is the downside of this. So the upside is these internet platform companies are just absolutely printing money. I mean, they have, I don't know if this is true. I didn't verify it. Apple has more cash on hand than the Federal Reserve. I think it was over $200 billion, because the Fed doesn't really hold cash. They hold liabilities and assets. But I just thought that was an amazing statistic. If it's true, I did not verify that it's true, but if it is true, that's pretty fascinating. But the downside of this is the S&P 500 is now over 22% the top 5 companies. So if you look at Google, Apple, Facebook, Amazon, Microsoft, they represent 22% of the S&P 500. And I would argue that it's justifiably so. I mean, the valuations on these big companies are not off the charts. They are somewhat reasonably valued given their growth rates.
And that's doubled in the past, decade, past 10 years. I think it was 11%.
Yes.
10 years ago.
Spot on. It's over doubled. In 2010, it was 11%, and now it's 22%. And if you look at the 90s, which I'm not looking at a chart of the 90s in front of me, you actually had a pretty diverse group of stocks in the top 5 of the S&P 500. It was IBM for a long time. It was ExxonMobil for a long time. It was AT&T for a long time. Walmart was there for a little bit. But if you think about those companies, that's communications, AT&T, it's technology with IBM, it's energy with ExxonMobil, it's retail with Walmart. You had 5 different types of companies, but it's hard to imagine. Like if you try and think out 10, 15, 20 years, it is very hard to imagine any world that those companies are not, you can imagine a world without those companies, but you can't imagine a world that internet and technology are not the new infrastructure. Because even if you believe in the Web 3.0 story, that is still internet cloud-based infrastructure. So even if Web 3.0 takes over the world, which by the way, me and Austyn are working on a 3-part cryptocurrency series or blockchain series, I should say.
Oh yeah.
That is built on technological platforms. Austyn, go ahead.
Yeah, that'll be sweet. I don't have much to say on infrastructure besides it. I mean, what do you have to say for the people who might think that's a little bit concerning, especially if you've seen, there's that documentary And there's a very brief overlap. What is it? The Social Dilemma or something like that?
Yeah, the Netflix one.
Yeah, you're seeing all this technological advancement, but you're not necessarily seeing the same regulation catch up with it. What happens when that regulation does catch up? I know we talked about these platform companies a couple podcasts back, and how there are other companies who are trying to essentially break that up. I mean, what's to say there? Do you think that growth will continue in those companies specifically, or just in tech altogether?
Well, so actually clients ask about that a lot, and it's something that I don't spend a whole lot of time thinking about, just because company breakups have happened over time. So like Amazon is one of the favorite companies that people like to talk about breaking up, because you could take Amazon retail and Amazon web services. Amazon has a competitor to everything. They are taking on FedEx with their supply chain. They are taking on Walmart with their retail. They're taking on Microsoft with their internet. Amazon is a really good conglomerate to think about breaking up. If they were to break up Amazon into the retail and the web services, you still would have two companies, and there's a good chance that Amazon Web Services would appreciate wildly in value because it's a high margin, high growth business, whereas Amazon Retail is a low-ish margin, high-ish growth business, but nothing compared to technology. So I don't think that, because like if you have 100 shares of Amazon and they got split up by the government, they could certainly lose some like corporate synergies that create value, but ultimately I don't think it would take away too much, because I guess I just don't worry about breakups, because you still own the company. You just own the broken up company.
In theory, it might not be the end of the world if a company like that, as big as Amazon, breaks up, and these stocks, these shares, I don't know what would happen in that situation, but I assume the shares would break up as well. It sounds like it's easier accessibility for investors at that point if you do want to own certain pieces of Amazon.
Yeah, it would be like you can buy, ticker for Amazon's AMZN that encompasses all Amazon. In the future, AMZN might just be the retail, the website, Amazon.com, and a retail service. And then ticker AWS is the Amazon Web Services, and ticker, AMFDX is the Amazon FedEx version. And it just becomes a bunch of different. What is it?
JEFF. They'd have to have a ticker, JEFF. Jeff.
Oh, for Jeff Bezos. That's a good.
Yeah.
I couldn't figure out where you were going with that.
I don't know if anyone has it, but it's worth checking out for Mr. Bezos. All right, sweet. Well, if you don't mind, let's move on to the second point.
Theme number 2, U.S.A. So every year, Denver Wealth Management, we take our portfolios and we run them through some of the most sophisticated software programs in the world. BlackRock has a software called Aladdin, which is awesome. Bank of New York Mellon has their software. That's the biggest bank in the world. And what we basically can do these scenario tests, like what happens if oil spikes 30%? What happens if oil drops 30%? What happens if emerging markets crash? What happens if the US dollar increases or decreases? And we stress test our portfolios against all these known scenarios. And then, we just basically get critiqued by these real smart people with real fancy software. And every year they say the same thing. They're like, Zach, Austyn, you suffer from home country bias. Just because you live in the United States doesn't mean that you have to invest your money in the United States. You should invest your money equally dispersed around the globe. And I agree with that. I don't think that because you live in the US, you should invest in the US any more than if you live in Haiti, you should invest all your money in Haiti. But I think regardless of where you live worldwide, the US is the best place to invest. So no matter what country you reside in, we have an unmatched track record of allowing investment companies to flourish and companies to flourish. And most importantly, passing that return on to the shareholders. If you look at this is a tweet, and I think we talked about it in a blog, China's economy has grown, I think, it's almost like 10% annualized since the early 90s. But the Chinese stock market has only returned 3% annualized since the 1990s. Well, so that's great for China. Congratulations. I'm glad your standard of living is going up, but that doesn't mean we should invest there just because the economy is growing. So there's basically 6 reasons you want to continue to invest in the US. And that is my second major theme. One is lack of corruption. Corruption is the single greatest threat to economies and investment returns. As soon as your country requires corruption to start a business and that fabric of trust is taken out of the economy, the decline is immediate and severe. And you see that in all the Latin American countries, a ton of these emerging markets where you have to go grease hands to get a business license. It makes it so you cannot be like a top tier economy. So the US is not perfect. If you look at the corruption index, which I have in a blog, I think we're 78%. So we're like in the top 20, but you can still get things done in the US without corruption. Second, historical stock market return. It's the expectation that in companies that are publicly traded return money to shareholders. That is not a norm. I mean, if you look at like Goldman Sachs, kind of my favorite company to talk smack about, from 2001 to 2020, I mean, their return to shareholders was zero. I mean, that is a company that doesn't have that kind of ethos that we make money for shareholders. They make money for themselves. So you need, and there's lots of countries like that too. We mentioned China as one where the economy and the companies flourish, but the shareholders don't. The US culture across the board is that good companies return capital to shareholders. Third is currency stability and strength. As long as the US is the world's dominant currency, we have a lot of advantages that other countries don't have, namely that we can just print much money as we want, give it to other countries, and their countries give us their stuff. If you've never thought about that for a minute, it's worth a little meditation session that the national debt is us making up paper and digital ones on a screen, sending them to countries like China, and then China sends us their physical stuff. I mean, that's unbelievable as far as like thinking about an empire. Our empire is we just give away fake numbers on a screen and they give us stuff. It's unbelievable. Fourth is rule of law. That kind of fits in with corruption. The fifth is patent laws and innovation. We are still the world leader in innovation. All the platform companies I mentioned just like 5 minutes ago, those are all US companies. If you look at, I'll scroll back up to my chart there, Alibaba, which is the Chinese version of a lot of our tech companies, only controls 6% of worldwide market share of cloud infrastructure. So if you look at the top, let's see, 1, 2, 3, 4, 5, 6, 7, 8 companies, American companies are 7 of the top 8 companies. So we still are the ones. In fact, all these other countries are just copying our ideas. Google comes out with a great idea and foreign tech companies just steal it, but we're still leading in innovation. We're also still 24% of the global economy, even though we are a fraction of the world's population. Austyn, we're 330 million and there's 7 billion people in the world. I don't know what the ratio is there.
Yeah, that sounds right. I haven't checked recently.
So we're 5, I check all the time. I think it's awesome. 5% of the world's population and 24% of the economy. Americans are kind of workaholics.
That's a good ratio.
Yeah, it's a really good ratio. So,
all right. Sweet. Well, hey, we're running up on about 25, 30 minutes. I know we promised 4 points, but I also don't want to breeze through the last 2. I think they're really important. So what do you think about breaking this into 2 podcasts?
I'm fine with it. How to make money in 2022.
Part 2. Part 1. Part 2.
1 completed now. Part 2. Part 2 is the most important if you're near retirement or requiring income or capital preservation in your portfolio. So in part 2, we will talk about inflation, interest rates, and stodgy, old, boring value investments.
Stodgy, boring value investments. Sweet. Well, thank you for listening. Zach, do you have any final thoughts? Any final quotes? You seem to be just privy with financial quotes, so maybe just one of those.
The stock market goes up 10 to 12% a year, and every year people are surprised. I think that's the most fascinating thing is like, if you read the year-end forecasts all these companies put out, they're so down, they're so negative. They're just all the doom and gloom in the world. And we're probably gonna be sitting here in 12 months and the stock market's gone up somewhere between like 10 and 25%, like it has the last 12 years. and everyone's going to be surprised. But as long as these companies keep making money and as long as the economy is growing, there's no reason that shouldn't continue. So I'm not predicting that number. You can certainly have a year where markets drop 10, 15%. They're extraordinarily rare. I mean, if you look at a 10-year time period, the market's usually up 8 out of 10 years and it's usually down 2 out of 10 years. And your average return over the last 50 years has been somewhere between 10 and 12%. So that's what I like to go for as a growth-oriented investor. I know that's a lot more than one quote, but there's no reason to be pessimistic in the long term. These companies are going to continue to grow and they're going to return capital to shareholders. And I want to be one of those shareholders, getting capital returned to me.
Sweet. Fires me up. Great. Thanks, Zach.
Merry Christmas. Happy New Year. Signing off from the Mile High City Mind of a Millionaire podcast.